Ladies and gentlemen, good day and welcome to Q4 FY24 Results Conference Call of CEAT Ltd, hosted by Motilal Oswal Financial Services Limited. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aniket Mhatre from Motilal Oswal. Thank you and over to you, sir.
Thank you, Ria. Good evening, everyone. Welcome to the post-results conference call of CEAT Ltd. On behalf of Motilal Oswal Securities, I would like to thank the management of CEAT for giving us an opportunity to hold this call. From the management team, we have with us Mr. Arnab Banerjee, Managing Director and Chief Executive Officer of CEAT, Mr. Kumar Subbiah, Chief Financial Officer, and the Investor Relations team. I would now hand over the call to Arnab sir to begin with his opening comments, and then we can take the Q&A session. Over to you, sir.
Hi everybody, good afternoon and welcome to CEAT's Q4 earning call. I'll be taking you through the business updates for the quarter and then I shall hand over to Kumar for his remarks on the financial performance. Then we'll be open for Q&A. To start with, we are pretty upbeat with the demand situation in India. Vehicle penetration is still low and trucks still don't travel 1,000 kilometers per day, so there is a lot of headroom. Government has been focusing on infra development and national highway network has grown 60% in a decade. The top players in the industry are well positioned with capacities in place and balance sheets that enable matching pace with this growth. The tire industry is cornering a growing share of India's manufacturing GDP and is expected to be reaching 3.4% of manufacturing GDP by 2032. We at CEAT had experienced a stellar year characterized by a very high profitability of 635 crore for financial year 24. Along with double-digit ROC. The success was further underscored by generous dividend distribution of 300%, and we had a stable margin for the quarter and also for the year and strong FCF generation. Our ratios have been strong with debt EBITDA being lower than 1 and debt equity at about 0.4. The tire industry, being one of the most competitive industries in India, is seeing good level of evolution with better pricing independence across segments. During Q4, we witnessed price cuts in TBR segments by some of the players, but at CEAT, we largely maintained the pricing with only marginal cuts in this category, while we actually enhanced prices a minor way in the passenger segment as well as farm tires. Q4 and the entire financial year has been a momentous year for us because we are celebrating 100 years of our existence in the tire industry. We continue to strengthen the brand with targeted market expense. CEAT has once again secured the rights to the IPL strategic timeout for the next 5 years. So this will be a cumulative of 14 years now where this brand property will stand for improving the salience of the CEAT brand. Volume performance, we grew by 5.4% in the quarter over last year, and our replacement and export market particularly have done well in Q4. Exports grew by 22% on volume, and we witnessed robust growth from Middle East and Brazil along with Europe. Off-highway tires also witnessed good growth in LATAM and the US market. Replacement grew by 5%, led by growth in TBR, passenger and two-wheeler segment. With our focus on premium categories, we have been able to improve our saliency in premium segments in all categories. PCR market share in replacement again increased this quarter and now we are close to 17% market share. In two-wheeler, we have crossed 35% market share and maintained leadership. We have gained market share in TBR as well, though we are still in single digits. OEM volumes in Q4 declined marginally, primarily due to decline in CV and in two-wheeler tires. Also on full year basis, our volumes grew by 6.5%, led by export and decent growth in replacement and OEM segments. By way of demand, domestic situation, as I mentioned, is upbeat. Inflation is moderated. We expect above normal rainfall in the forthcoming monsoon season. We expect in most categories high single digit to touching double digit kind of volume growth in OEM and replacement markets. The landscape of tire manufacturing is also being reshaped by increasing focus on sustainability and the already well-known trends of CASE, which is connectivity, autonomous, electrical, and shared mobility. On the margin front, we should share first that the commodity basket has been flattish in Q4 versus Q3 in line with our guidance. Natural rubber prices are trending high, which had marginal impact in Q4. But if this trend continues, we could have an escalation of RM cost by 3 to 4% in Q1. We have been able to maintain our pricing in OEM segment and export markets. Operational efficiencies helped us to not affect our margin profile significantly. Standalone EBITDA for the quarter stood at 13.4% and standalone net profit was 119 crores. Capacity utilization continues to be good in the range of almost 80%. I will cover now the extended producer responsibility, which is EPR. In July 22, the Ministry of Environment, Forest and Climate Change issued regulations on EPR for waste tire applicable to tire manufacturers and recyclers. This would mean that the goods sold in domestic market in T-2 years will be considered as base for calculating our obligation. As per this, the company has an obligation as on March 31st, 2024 for FY24 and also for FY23. We have provided for the same on a prudent basis, while the matter has been represented to the government by the company and industry forum to apply EPR prospectively and with changes in modalities. We estimate the overall liability to be 107.2 crores for both years FY23 and 24, and this has been provided in the books in the current year, out of which 34.5 crore pertains to FY23 obligations and has been disclosed as an exceptional item during the quarter and year ended March 31st, 24. There has been evolving clarity and the relevant ecosystem is gradually coming into place for EPR related costs and action. Going forward, we shall be providing for 100% of the quantity of new manufactured tires based on this formula. This will work out to roughly 1.2 to 1.4% on domestic sales. We expect that we will be able to mitigate this impact on our margins in the medium to long term due to improved product mix, pricing and internal efficiencies. On the future trends, electrification, we continue our good work in the electric vehicle segment. In the passenger EV segment, we have entered Tata Punch EV, which is a high volume vehicle. With this entry, we have become a supplier to all EV OEMs that are locally manufacturing in India. We now have close to 20% share in the passenger EV in India, and we also have a share of around 27% in the two-wheeler EV ecosystem in India. In the commercial EV segment, we have got an entry into Switch Mobility's first vehicle, as well as Volvo Eicher's new EV SCV, which has been unveiled recently. Internationalization has been a key driver. We have launched 55 plus off-highway SKUs in Q4. Export business is margin accretive for us, and therefore we'll continue to invest in product mix for agri-radial and PCR and TBR. Right now, the exports constitutes about 19+%, and we would like to take this up to 25% in the next couple of years. Mahindra launched their Oja tractors in US, completely fitted with CEAT tires. We are progressing well on channel expansion in US market. The macro situation in Sri Lanka is improving gradually. Passenger tire demand has improved there. However, commercial tire demand is still to come up. On the premiumization front, we launched the steel radial, sport rad and cross rad in the two-wheeler range. This is meant for high-performance motorcycle. The current potential is about 3% of the overall market and is expected to grow fast. We are also associating with premium properties such as the KTM Cup, and we are sponsoring several adventure biking events as well. Our share in premiumization continues to improve, and in PCR, cross drive, sport drive, Secura drive, and Secura drive SUV continue to gain saliency in the whole category. We will continue to invest in marketing spends, which hover around 2% plus range year to year, and which is the highest in the industry. As mentioned earlier, our coverage for tires required for BMW, Audi, and Mercedes continues to be in the range of 85 to 90%, and despite rapid introduction of new models, we'll continue to launch products to keep the coverage at this range. We will continue to have highest R&D spend as compared to peers in the industry for new product development for Indian and global markets. Our exclusive outlets have reached 550 numbers by the end of this year, and our distribution expansion continues into the hinterland of the country. On the digital front, CEAT received Smart Manufacturing Company title at CNBC TV18 Network Smart Manufacturing Summit 2024. We continue to deploy the Industry 4.0 initiatives from Halol to our Chennai plants in line with the Lighthouse concept. We have had a good engagement in all social media platforms. We continue to focus on increasing our connect with end users digitally. Brand searches for premium vehicles and SUVs grew by 9 times, 60% increase in brand conversion volumes, and 156% increase in average engagement per post per month compared to FY23. Furthermore, through website leads, we registered a 50% increase in premium sales. Our capex for FY24 ended at around 860 crores. The expansion projects are on plan. We reiterate our strategy of doing bite-sized capex every year. In line with this strategy, we expect around 1,000 crores of capex in FY25. We are focused on reducing our carbon footprint. Ton CO2 emission per metric ton of production was lower in FY24 by 7%. 36% of our plant power requirement is through renewable sources. And at Bhanduk plant, which is in the middle of Mumbai city, we installed an auto carbon charging system, which is good for the environment. Natural rubber sourced via alternate transit route went up to 26%, and the rolling resistance of tires went down by 5%. Overall demand situation is good. We are upbeat about the India story, as I mentioned, and there is a mild inflationary impact in raw material prices. There is an EPR impact, and we expect to mitigate the impact of this escalation through better management of our resources. With this, I would now like to hand over the call to Kumar.
Thank you, Arnab. Good afternoon, ladies and gentlemen, and thank you for joining our Q4 FY24 earnings call. As it is a year-end, I will share some financial data points relating to the Q4 and also full year, post which we can take Q&A session. Overall financial performance, our consolidated net revenue for the quarter stood at 2,991 crores, year-on-year growth of 4.41%, driven by increase in volumes. Our consolidated EBITDA for Q4 stood at 400.91 crores, which is about 5% higher than the same amount of the previous quarter. The EBITDA as a percentage is a little lower in the current quarter versus the previous quarter, mainly on account of advertisement cost and regulatory cost. The regulatory cost aspect has been already touched upon by Arnab. I'll also explain briefly in terms of the impact of it. Coming to gross margin, our gross margin saw an improvement of approximately 100 basis points, driven by better mix and the impact of higher inventory at the end of the quarter. As we come into the current quarter, the prices of key raw materials like natural rubber and crude derivatives have shown an upward trend. In case of natural rubber, we're seeing an upward trend since the beginning of the previous quarter. and the same is likely to impact our raw material costs in Q1 to the extent of about 3 to 4%. And the crude has seen some correction in the last 2 or 3 days, and we hope it sustains at the current level. And if it sustains, that the impact on raw materials could be lower. Considering these factors, we'll continue to keep a close watch on RM situation, and based on how it evolves, appropriate pricing decisions will be taken. Coming to debt, capex, and working capital, we spent about 260 crores of capex during the quarter. So far, and on an overall full year basis, we spent about 866 crores, which is broadly in line with our indications given in the earlier interactions. I'm happy to share with you our overall operating working capital came down by about 102 crores during the year, and largely driven by improvement in inventories and receivables. We are also happy to share with you that we generated a healthy free cash flow of 857 crores during the year, which is the highest, and that helped in terms of funding all our capex during the year from our internal accruals. Our consolidated debt stood at 1,629 crores as of 31st March, a drop of about 470 crores versus the same period of last year. Our debt to EBITDA on a consolidated basis stands at a comfortable level of 0.97 and debt equity of 0.4. Our debt EBITDA of 0.97 is the lowest in the recent years. Coming to operational expenses, our employee costs largely remained flat at the same level as Q3. Our marketing spend has increased during the quarter on account of new campaigns, participation in IPL and WPL. This will continue in Q1 as well due to IPL in Q1. For the year, as we had explained in the earlier on EPR, during the year, we made a provision of about 107 crores towards extended producers' responsibility. Out of the 107 crores, 35 crores relates to the previous year, and therefore we have reported as an exceptional, and balance amount has been shown as other expenses in our consolidated as well as standalone books. In the Q4, we approximately provided about 40 crores after adjusting the provisions that we made in the earlier quarters. The impact of this additional provision that we made in Q4 is close to about 1.3% of the EBITDA for the quarter, and this may be appropriately considered while making comparisons with the previous quarters. Depreciation for the quarter increased due to higher capitalization and commissioning of our assets, and we expect it to remain at this level for the coming quarter and in the first half of the year. Interest costs declined during the quarter compared to Q3 on account of lower debts, and effective interest rate has largely remained the same in line with Q3, and we expect the interest rates to be in the range of about plus or minus 25 basis points into Q2. On a consolidated basis, we have an exceptional cost of 58.17 crores. As explained just now, it includes close to about 35 crores relating to EPR. We also had a voluntary retirement scheme launched in one of our factories, and the cost of that is about 7.98 crores. And during the year, we also made some changes in the distribution model in Bangladesh, and leading to reconfiguration of our business model, and therefore we took a call to take a write-off of some of the assets in our Bangladesh joint venture entity, and the impact of the same is about 15.66 crores. Our overall consolidated profits for the quarter stood at 92.87 crores, and on a full year basis, it stood at 614.48 crores. In the board meeting, the board recommended a 300% dividend for the last year, which approximately translates to about 20% of our profits, and this is subject to approval by shareholders in the upcoming annual general meeting. With this, we can now open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your question to only one question per participant. Should you have a follow-up question, we request you to rejoin the queue. First question is from the line of Arjun Khanna from Kotak Mahindra Asset Management. Please go ahead.
Sir, thank you for taking my question. The first question is on the extended producer responsibility part of it. So if you could help us understand why was it just taken this quarter, given that it came or was notified since 2022 November. The second part to the question is, are we registered as a manufacturer and recycler, or what registrations have we taken? And lastly, in terms of the recycling bit, is there a way of doing it ourselves and reducing this cost base of what you mentioned of 1.2 to 1.4%? Thank you.
Okay, see, this notification was issued in the year 2022, as you mentioned, around that period. For producers of tires to implement the recommendations of that particular notification. So some of the conditions included having a portal, registered dealer for recycling tires. So that infrastructure did not exist in 22-23. In fact, even the first 9 months of the current year, 23-24 also, the infrastructure was not fully in place. It is because of accounting prudence and to ensure that we follow the principles of conservatism. Okay, we have made this provision. The company as well as the industry body has taken up with the government already to explore options or requested the government to make it effective prospectively and also with some changes in modalities. So it's in the absence of clarity with respect to establishing the impact of it and also inadequate infrastructure. Okay, it was decided in the previous year not to provide for the same thing, and even in the current year also, only towards the end of the year when the government started insisting on fulfilling the obligations, it was felt that it is better to reflect it in our financial books. In our books, we started providing it from the beginning of the year based on our own internal estimates. When we came to some kind of a certainty with respect to the amount, and we decided to provide it in Q4, whatever was unprovided, and also relating to the earlier year. The next question, we are not recyclers, so therefore how we would like to fulfill the obligation is to buy certificates from recyclers who will buy those tires from the market and then recycle them and convert them into another useful product, and we will buy those certificates from them. And the cost that we have shown in our financial statement is the cost of certificates that we would have to buy from these recyclers. And we have not registered ourselves as a registered recyclers. Those who are in the business of recycling have registered themselves in the portal as a registered recyclers.
Sure, thank you. That's very helpful. So just as a supplementary question on this, in terms of ERP certificate costs, have we seen an increasing trend, and are they available to the quantum that's required at this point in time?
No, it is not available. It all depends on what is the extent of obligation. Okay, and as we said, it is because of accounting prudence we have made all the provisions. It is not available. It started, some quantity started being available in the portal from Q4 of the last financial year, more in the later part of it. If someone were to theoretically arrive at the total obligations for this period of previous 2 years and what is required in the current year, a fraction of it is what is available at this point in time. And in terms of pricing trend, I think it's too early to say anything. It's just starting, so and I think we'll need more time to understand whether the prices will remain at current market level or will it increase or go down. So I think we need more time.
So just to understand, the number that we have utilized for this quarter is essentially the current pricing in the market. Is that the right understanding?
No, we have not utilized. We didn't buy anything in the previous quarter.
No, I'm saying the quantum.
Accounting provision.
Yeah. So the quantum for the accounting provision is the current price of the ERP certificate may not be available in that volume, but we have used that price into the quantity of recycling that we are supposed to do, that 35, 70%, etc.
No, we have considered the current prices. We have also and made some understanding because the quantum involved is large, so we made certain assumptions with respect to what is likely to be the pricing, and accordingly we have estimated the liability.
Sure. Thank you very much.
Welcome.
Thank you. Next question is from the line of Siddharth Bera from Nomura. Please go ahead.
Yeah. Thanks for the opportunity. Sir, again, just to clarify this point, we have provided 40 crore in the current quarter, and the remaining 30 crore has been provided in the first 3 quarters. Is it the right way to understand this?
Yeah.
Okay. And second is, when you say that the quantum provision for the next year will be somewhere about 1.2 to 1.4% of domestic sales, again, this can vary depending upon the pricing in the market, or do you think this is largely decided and it won't change basically if you look at the full year?
No, it's an estimate. Okay, and it will change because the cost of certificate is what we are taking it as a cost. If the certificate cost comes down or goes up, it will have some variation. It is more an indicative number for somebody to understand the implications of it. So needless to say, any variation, any movement in the prices will have some impact on the current estimate.
Got it, sir. And sir, the second question is on the volume.
Hello. Could you please return to the question queue for follow-up question?
Sure.
Thank you. Next question is from the line of Amar Kant Kaur from Axis Capital. Before that, ladies and gentlemen, in order to ensure that management is able to address questions from all participants, please limit your question to only one question per participant. Mr. Gaur, please go ahead with your question.
Yeah, hi. Thanks for taking my question. My question was regarding the RM escalations that we have seen in the recent past. The natural rubber prices are up significantly when the crude may not be. So in your estimate, how much price increases will we have to undertake to mitigate those kind of impacts on RM, and how much have we taken, and any clarity you can give on the price hikes that you have taken yet?
Yeah. So coming to the price hike, we did mention that we took a very moderate, very little price hike in Q4 itself in farm and PCR, not in across the category. In the month of April, by April end this year, in this quarter, we have taken a price hike of around 1.5% in replacement, and we are in the process of converting our orders to the new pricing in international business. That also will be around 1.5% to 2% as it settles down. OEM is indexed, as you know, so OEM pricing is we'll know the index and calculate the pricing at the end of Q1. So that is the pricing situation. So if the price hike is the raw material hike is 3 to 4%, then you need about 1.5% to 2% at least to mitigate. So with a lag, I think we will be able to mitigate most of the price hike requirement.
All right. I have follow-up questions, but I'll fall back in the queue.
Thank you. Next question is from the line of Raghunandan NL from Nuvama Research. Please go ahead.
Thank you, sir, for the opportunity. My question was again on EPR. Sir, can you please explain the computation? Because when I look at your last 2 years of calculation, it comes to 1.5% of domestic sale in FY23 for 35% 2 years ago, and 1.4% for FY24. And for 25, you've given a range of 1.2 to 1.4. One of your peer who also reported results today, for them the math works out to something like 0.8 to 0.9%. So as per that EPR document, it was showing that the calculation is based on weight into conversion factor into quantity. So how